Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, so we're going to talk about institutional home buyers because they are getting ready to come back in the housing market and start buying.
Okay, and by institutional, we don't mean the people in the straitjackets, but that is a possibility.
No, we're talking about the big firms. You know all the names. What really surprised me was how it was sort of put together in this article by the headline. Because you read the headline, and then as I got through the article, it was completely different from the headline.
Because the headline, as usual, was clickbait.
Clickbait. Okay, this is the headline. This institutional home buyer has completely stopped buying. Why the 2023 housing market has Wall Street types timid.
And
They're super timid.
Okay.
They're scared to death.
all right, so first of all, has anybody ever known for Wall Street types to be timid about anything? The answer would be no.
Okay. So the crux of the article is that there's this one institutional buyer, one of them, that basically said last fall or last winter, hey, we're not going to buy any houses this year. We did a video on it. We talked about this. We showed all the data because we show all the data, the stuff that's good, the stuff that's not great, right?
Right.
Okay.
And then we let you we show the data and we let you decide if it's good or not great.
We report, you decide.
That's right.
Okay? No trademark copyright infringement there. All right. Fast forward to August 2023. Not only have house prices in the majority of housing markets stabilized after last year's mild price correction, but interest rates have also seen an increase. You can go back to our videos from more than a year ago where we said home prices would correct.
Right.
Okay. All right. Okay. Now, the absence of any interest rate and housing price relief explains why Joshi has recently informed Fortune that through July, Yield Street, which owns around 700 homes, has not made a single purchase in 23. They're actually functioning as net sellers this year with a total of about 10 homes sold.
So they own 700 homes and they sold this astronomical number of homes. 10.
10 nationwide, the whole U.S. Okay?
Okay, so I'm willing to bet that if you bought 700 homes, there would be 10 duds in there, okay? Probably if you and I bought 700 homes, there would be probably more than 10 duds in there.
Yeah, for whatever, they sold the 10 houses. Heading forward, Joshi doesn't expect much relief in the form of house price declines. So they are not predicting home prices to drop, which is why they're not really selling. They're not selling their massive portfolio. Adding that I think national home prices have bottomed at this point. Now, this is August 2023. This article just came out and these interviews just happened. My expectation was they'd fall, but because of no inventory in the market, prices found the floor. I don't expect major declines in most markets.
Right, so...
Except for, of course, a super overbought market maybe. There might be declines.
Right.
But in most markets, there's not going to be declines.
Right, and then do remember that these guys are not purchasing in all markets. They're probably purchasing in about 20 markets. So that is a consideration.
Right. Okay. More of the article. Instead, Joshi hopes that the interest rates soon start to fall, given that inflation has decelerated significantly. If that happens, returns, cap rates, would improve more, and more institutional home buyers might jump back in the market. Okay, here's the key data you guys need to know. This is 2023. By 2028, Yield Street hopes to grow its single-family home portfolio from its $200 million value entering 2023 to $1.5 billion. If the company goes through with it, that'd mark a 650% increase in single-family holdings by 2028.
So, here's the thing. He's telling you that he's going to be purchasing homes. Now, do you think that he's going to wait until interest rates start to move? Or do you think he's going to make purchases in anticipation of interest rates moving? Look, these guys are money managers. These guys know what they're doing. They're not going to wait until the retail people are, having a feeding frenzy in the market. These guys get paid good money to anticipate the market and to purchase ahead of mom and pop investors and certainly, owner occupants. They have a lot of resources to do a lot of research. And my gut says that they're not going to wait until interest rates start to move. I think they're going to probably start to purchase regardless of what interest rates do, probably as soon as maybe September. And they will start this whole process because I can't imagine that they're going to wait for interest rates. These are not people who are reactive. These are people who are proactive.
Well, they don't want to rate. If interest rates drop, mortgage interest rates, they're facing competition from other buyers, from people that are just buying, right?
Right.
And the other thing too is this. Okay, they want to obviously they want to buy the homes at the cheapest prices possible. If I had to guess, the order of home prices from most expensive to least expensive from between now and 28. I'm just guessing, right? I don't know. Nobody knows. I would guess 2028 are the highest, and the second highest is 2027, and then the third highest is 2026, and then the fourth highest is 2025, and then 2024, and then 2023.
Right.
Because if you look at home prices historically, they tend to go up. Right. So it's not like they're going to wait until 2028 and buy them, although they'll probably be buying them as fast as they can get cash. I thought this was fantastic. Now, here's the other thing, Wanda. Do you think other institutional buyers, or whatever data is causing them to want to 650, 6.5x their holdings, other institutional buyers are going to do the same?
Absolutely. And this goes back to something that we've been talking about for the last few years, which is all of these homes being locked up. So now we're going to be dealing with what we've been dealing with: institutional investors owning homes that are locked up, that are never going to see the light of day as far as being sold on the open market to individuals. And then we have all the homes that have sub 4% interest rates that are going to, the majority of which probably won't see the light of day on the market either. So this kind of lets you know that the housing market's going to get tighter and tighter. So the less inventory there is, the more price pressure there is. So these people understand that, and these people are going to take action. And I think that's going to be something that this whole lack of inventory is not going to get better. I think it'll just get worse, not better. And I very seldom am a crash bro or crash sis or whatever. I'm very seldom that way.
You'd be a crash bro.
I'd be a crash bro, okay. So I'm not a crash bro, but I do understand supply and demand, and I do understand that these homes are going to be taken off the market for our purposes permanently. Because it's going to be so long-term that for you and I, it may as well be permanent. Okay,
now we got some great charts and other data here. Okay, so here's the first one. Look no further than American Homes for Rent, which through June is about 780 homes in 2023, while selling off 1,081. Okay, simply put, through the first 2 quarters of 2023, American Homes for Rent is a net seller. Now, what I'm going to do is I'm going to jump to this chart. This is American Homes for Rent. You can see that they, in 2020 and really 2021 and first part of 2022, they were by far buying more homes. The red is purchased homes. The black is sold homes. And you could see the end of 22, beginning of 23, they were selling more. But the second quarter of 2023, all the way to the right, they're a net purchaser. They've added more homes in the second quarter. You can see where this is getting ready to go. They're sort of back in the mode of buying. And remember, they have 58,693. It says they're no longer on a buying streak because it's more balanced, but you could sort of see where this is starting to go.
Right, and the thing you have to understand is they're selling homes because they're trying to balance their portfolio. They're trying to get to a certain rate of return. And homes that do not meet those investment goals will be sold and replaced with homes that do. So just because they're selling homes doesn't mean that they believe that there's anything wrong with the market. They simply are evaluating those particular assets, and they're not performing according to their standards. So they're shedding those and replacing them with assets that they believe will perform better.
Okay, now this is the most interesting one. Okay, guys, because we literally said this would happen. Okay, through June, the first 2 quarters of 2023, Invitation Homes, the country's largest owner of U.S. single-family homes, has sold off more homes, 675, than it acquired, 470. At the end of the second quarter, Invitation Homes owned a total of 82,837 homes, down from 83,148. And then I'll go to the chart. Here's the chart, Invitation Homes. You could see the same sort of trend. They've acquired, although they're net, they've sold more. They've acquired more than they did in the last 2 quarters, right? So you look at the chart and you can see that the natural trend is that they've been acquiring more overall. But here's the amazing thing, okay? Already this quarter, we're in the third quarter of 2023, okay? Invitation Homes is poised to resume its role as a net buyer in the third quarter of 2023. This anticipation stems from its recent acquisition of a portfolio of nearly 1,900 homes for approximately $650 million on July 18th. So publicly traded company, they had to disclose this. It's important to note the Invitation Homes procured the 1,900 portfolio from another institutional firm, thereby indicating that on a net basis, the transaction did not contribute to overall increase of institutional ownerships. So they didn't say who, but they went to another person, an iBuyer or an institutional buyer, and said, hey, you've got this portfolio, we'd like to buy it from you. Because remember, when they do that, what things do they avoid when they just go buy all the homes?
Right. So this is something we've talked about a lot, probably for over a decade. So these institutional buyers, they're purchasing these homes in entities, right? So, ABC LLC, right? And they've got a certain block of homes in ABC LLC, and then they go and they sell it from, this institutional buyer to that institutional buyer, and they sell the LLC. Now, when they do that, several things happen. First of all, these homes never see the light of day as far as you and I having the opportunity to purchase them.
They don't go into an MLS.
They don't go into an MLS, so you don't see them. They also do not impact the market value of that market or those markets, because remember, they're not competitive, right? They're not competing in the MLS, so they never even show up as a value.
We don't know what they purchased them for because they bought the whole block. It's not like they go in the tax jargon to figure out what they pay.
So because they're purchasing the whole LLC, depending on the jurisdiction, they're probably avoiding property transfer tax, which is, like in Nevada, that's a good bit of money, right? It's $5.10 per $1,000.
It's 0.5%. So on a $500,000 house, it's $2,500.
Right. They're avoiding realtor fees. They're avoiding title fees. They're avoiding all kinds of fees in doing it this way. So while if they sold the homes individually, it would cost them at least 8%, at least. This way, they wipe out all, if not at least some of those costs. So it's a very efficient way to do it. And again, it does not impact that market. And this is super important because by not bringing these homes on the market, it has no impact on that market. So even if the homes are sold for, let's say, 2% less than the going rate, that doesn't show up. So it does not negatively impact the value of the portfolio. So that's a really interesting fact to keep in mind.
Okay. Here's another quote from the article. Stabilization in the debt markets, for one, also increased supply of resale homes. Until the debt market unsticks through lower interest rates, there needs to be more homes to buy at scale. Noel Christopher, a longtime leader in the single-family rental space, tells Fortune. Those institutional home buyers with a long view are gearing up to buy. Mm-hmm. I know this for sure. There have been much speculation from YouTube content providers, Crash Bros, Housing Doomers, who believe the large investors will dump rental homes to get out of the trade.
Absolutely not.
This has been done. That has been debunked many times.
Right.
So what they're saying is one of the reasons they backed off is because they've realized housing didn't crash. It corrected. They could see home prices are going to start going back up again. Even with high interest rates, home prices are going up. There are just not enough homes. But the problem is once more homes hit the market, these institutional investors all flood back in to buy, making it hard for mom and pop investors, for people who just want to become homeowners to buy. Right. It's going to get harder to buy houses. And if all of could you imagine if every institutional investor bought 6.5 times as many homes as they have now in the next 5 years? What that would do to home prices, the housing market, and everything? Right.
And keep in mind that they are not buying at every price point, right? So who are they really impacting? So I think that's an interesting discussion to have.
They're impacting the people probably who watch the videos.
Right.
So they're not, if you're super rich and you've got like a vacation house in Coronado, they're probably not buying in Coronado.
Right. So we're not talking these $5 million plus homes, okay? We are generally talking the somewhere in that sweet spot. Like for example, in Las Vegas, the sweet spot is between 300 and 450,000. So that's kind of the sweet spot, because those are going to be homes in desirable neighborhoods. They're going to be homes in generally reasonably good condition. They're going to be homes in growing areas. They're going to be homes in areas that have amenities like restaurants and good schools and that sort of thing. So that's really a sweet spot. And those are the homes that are most desirable by owner occupants, right? Those are the majority of homeowners. They're either the first-time homeowner or the move-up buyer. So these are the people basically under 500,000 in most markets that are going to be impacted. Now, once you get to to a higher price point, I think there's a lot less appetite for the institutional investors because the ROI isn't there. And this is what you need to understand. It's about the return on investment, right? So if you're spending, let's say, $400,000 and you're getting $2,700 in rent, that's fair money. If you're spending $700,000 and you're getting $3,500 in rent, not so hot. So that's where what we're talking about as far as which homes are most desirable by the institutional investors, because they are rentals. They're also going to be homes that are easy to maintain, homes that are easy for them to renovate, that require minimal renovation. So what do institutional investors do when they renovate a home, right? They do very simple things. They do paint, they do flooring, maybe appliances, and that's about it. So, you have to keep in mind that return on investment and where that makes the most sense for institutional investors.
Here's the other thing about institutional investors. These have this huge unfair advantage. Okay, imagine this. You want to buy a house. Mm-hmm. You go pick an area that you think is pretty good. You like the school. You tell your agent you want these things in the house. You go out there and look around and you find something. It's actually pretty arbitrary. You don't have a lot of data. Like, you don't know what's the potential for appreciation and like how many, what your percentage you would be able to sell the house, in the future based on the zip code and all these other demographics, right? Okay, same thing with investment property. Like the last investment property we bought, that it just happened to be very close to our house in the area we live. Mm-hmm. It was an opportunity that just came up to us. They have to sell, it's cash, it's substantial discount. We took advantage of it, right? But we didn't have data for the whole city, and then we went and nailed it. We should buy a house in 89108 between 200 and 250 because that's like the highest percent. So we buy 12 of those, right? We didn't do that. Okay, here's the thing. All these institutional investors have all these analysts whose job is to seek out the price points and the areas that they should purchase all over the country. Because think of it this way. If you're an analyst and you can just get a 1% better deal or future sale on a home at a $400,000 price range, that's $4,000. And if your buyer comes in, who you work for, and buys 1,000 houses, and you've saved them $4,000, that's $4 million. Mm-hmm. So they have the ability, they're leveraging data, they're making data decisions on these. So what's happening is they're basically skimming off everything they think is going to be the best deal in real estate, which means they're probably unlikely to sell them in the future. And the rest of us, including us, we're just sort of guessing. We're just like, hey, we got it kind of cheap because they had to sell, so let's just go in there and buy that, or we like this area because we used to live there, or whatever.
Right. And lastly, let's talk about what happens when these institutional investors come back to the market in force. Can you compete with them? They're going to be able to do 10-day closings. They're going to be able to pay cash. They won't care about a whole lot of things that you and I might care about.
They'll waive everything.
Right. They'll waive everything. No appraisal, no contingencies. They'll just come in and just do the deal. While a regular buyer is going to have to probably get a loan, and they're going to have appraisal contingencies and inspections and all this other stuff. And the seller's going to go, you know what? I'd rather sell to an institutional investor for $5,000 less and know that the deal is done than wait for an owner-occupant that is going to take 30, 45 days and might fall out because at the last minute he might not qualify for the loan. So owner-occupants are going to have a much harder time than these institutional investors, which they have. The institutional investors have always had the advantage, and they will continue to have that advantage. And like I said before, I think that they're coming to the market. They're coming to the market earlier than other buyers will, because they are anticipating the market. Like Todd said, they have lots of brilliant analysts and lots of tools at their disposal to anticipate the market rather than react to it, which is what most people do. Most people react, they don't anticipate.
Okay, so here's to reply to some comments that we've had about this. There's a lot of people who have rightly come on, I don't disagree with this, to say wages really have to climb to sort of catch up. And this is, I don't disagree. Yes, it would be, we do need wages to climb. Wages are climbing at like 4% a year. Housing is typically outperformed wages by a couple percent a year. And the reason is because people just have more wealth over time. But here's the big problem. If you get institutional buyers that are a large percentage of the buying population over the next 5 years, then that, again, limits the number of homes. So when you say, but what about that person who makes $40,000 a year who's trying to get FHA and put 3.5% down? They're not going to be able to buy because you're going to have the institutional buyers. Then you're going to have high net worth individuals. Then you're going to have current investors who have a lot of rental income and they have a lot of cash coming in. And then you're going to have high net worth individuals or high income individuals. Mm-hmm. And then you're probably going to have like medium to high income individuals. And then nobody else will be able to buy a house.
Right.
So we could end up in and this is not in all markets. Like they may not go to Enid, Oklahoma. Like in Enid, you may be able to get a house. But they may say, hey, we're going to Tulsa and Oklahoma City.
Right.
Enid's fine. Go buy a house in Enid. We don't want to, America Homes for Rent or whoever may not want to deal with that market. Right. So that is the problem is in some markets, probably Vegas, Phoenix, Atlanta, and, most of the South and Sun Belt is probably going to be competing with, probably not La Jolla. But the rest, everyone else could be competing with these guys, and it's going to drive up home prices.
Right. So kind of what I said before as far as the homes that are maybe $700,000 and getting $3,500 in rent, that doesn't make sense. The same happens on the bottom end, right? That they're not going to spend $250,000 on a house that they can only get $1,000 a month in rent. So it's kind of the same kind of thing. That's why I said that there's a sweet spot for investors, right? They don't want the very bottom, and they really don't want anything in the upper ranges either. So depending on the market, I think that's what you have to watch out for. And let's face it, most of us are in that sweet spot, right? Between 300 and 450, depending on the market. What did you think? Did you like the charts? Did you enjoy the discussion? Did we give you something to think about? Did we entertain you? Thank you for spending your time with us. We appreciate it. Please remember to like the video, subscribe, hit the notification bell, share the video, leave us comments, tell us what's happening in your market. Tell us what you think about all this. We're interested in your opinion, and we'll see you on the next video. Bye.
Bye.